3 months ago, Brent crude was $64 a barrel. Now we're up to $100. That's a 60% increase. Those two firms in particular over the last 3 months are up 17% each. They've done really well. So there are always opportunities. Hi, and welcome to the Money Minder Market Insights podcast. My name's Ray Black. I'm the Managing Director of Money Minder and a Chartered Financial Planner. Today I'm joined by my friend and colleague Graham Page, who's also a Chartered Financial Planner at Money Minder. Earlier on in the week, I was asked to go onto BBC Radio and make some comments about what was going on with the Iranian conflict and oil prices, what it might mean for markets and investments and pensions and such like. So we thought this was a great time to have a chat about what that means to our clients and investors across the UK at the moment, and hopefully give you a bit of an insight as to a little bit more about what's going on and what the future may or may not hold. Graham, great to see you.
Hello, Ray. Hello. End of the week, another busy week, and obviously lots to talk about, really. Should we start in the Middle East? There's obviously this ongoing conflict. So oil prices at the moment have been spiking. So what do you think's driving oil prices at the moment?
Well, as we've all seen on the TV and on the news, that Strait of Hormuz is a real problem area. They're letting through some Iranian and some Chinese tankers at the moment, but pretty much anything else that wants to get through there is at the mercy of Iranian drones at the moment. Potentially the Iranians are saying they will do everything that they can to close down the strait at the moment and not let that oil through. That's what spiked prices up to the point now where 3 months ago, Brent crude was $64 a barrel. Now we're up to $100. That's a 60% increase, not a 40% increase, because it's a 60% increase on the original $64, per barrel. It now takes it up to $100 a barrel, and it got to closer to $120 a barrel at a couple of points during the last week, but daytime trading, not close of business as well. So it's all about energy and being able to run everything that we need to be able to run. Everything that we do, the fact that we're talking on this video conference at the moment, what we put in our cars, what we eat, what we're going to do at the weekend is all energy dependent. And so when that supply is constrained considerably, prices go up and we see it in our pockets straight away.
How do you think that's going to impact on inflation in the UK?
Well, that's the thing, because it's so linked, it's highly likely that we'll see the cost increases coming up in not too distant a future. I heard recently that one of the garages locally put their prices up within a day or two, as it's normally takes a week or two to get through. But I heard recently someone was saying to me that they've seen the prices go up pretty much straight away. I also heard when I was talking on the radio the other day, the DJ that I was speaking to, the presenter I was speaking to, was saying that one of the listeners had rung in and said that they priced up filling up their oil tank a couple of days after that they'd just done it, and it had nigh on doubled. And there's a concern about that because people think the companies are profiteering because this oil's already here. But what they were actually forecasting there is future prices, and if future prices of oil is going up, and gas, and it's all coming through, or I think it's about a fifth of the world's supply comes through the Strait of Hormuz. So it's not everything, but it's a lot. And if that's going up and up and up in price, it affects everything. That therefore then leads on to inflation spiking again. We remember that from 2022. I think October 22, RPI got up to over 14% over a 12-month period. If we've just had a 60% increase in energy costs, in the oil price, then it's very possible that we could start to see that coming through into the supermarkets very soon. So the inflation outlook is not so good at the moment, and I think people need to be prepared for the cost of living in what's already a tough time going up further.
I mean, we've seen Trump and his tweets, obviously, quite a bit of a movement in oil prices recently. How long do you think this is going to last for? What do you think is his end game? with Iran?
Honestly, I'm not sure that he's got one, and I think we've heard that. Those of us that are watching the news and seeing what's going on, I think we've all heard that. I'm not sure that there is really an end game, and whatever that end game is, it keeps changing. What I don't think he took into account was probably much of the advice that his advisors would have been telling him before he actually started really devastating the Iranian targets that they'd picked. And I mean, they absolutely went to town very, very quickly. And whilst I'm not sure that anybody's actually seen the new Iranian leader, the supreme leader, it's the last one's son. The last one was in his 80s. So this guy's a bit younger. And from what I hear, he's just lost his father, his wife, and maybe a child as well recently to this whole thing. So he's not going to be very keen on down tools and complete surrender, as Trump was first talking about in the first week or so. And we see constantly that countries around the Iranian area are being targeted. Anything that's to do with the US and bases, energy infrastructures, and communication structures in those areas, the Iranians are targeting. And depending on how many of those small drones they've got, they could perhaps keep that up for a long time. That's the major worry about inflation, that actually Mr. Trump thinks that it's going to be over in a very short space of time because he's hammered the place, which is awful just thinking about it in the first instance. Regardless of the need to change the regime, there's still people's lives involved with this. So it's awful from that point of view. But if the new supreme leader, and it wouldn't be terribly surprising to find it happens, if the new supreme leader gathers some support from the Iranian people, which isn't a small population by any means, and they have been pretty technologically advanced over the last few years as well. It's sanctions that have held Iran back over the last few years more than anything else. If he's got enough support, this could go on for months and months and months. Look at Russia and Ukraine as another example. That was supposed to be over in a few weeks, and here we are 4 years later.
Yeah. So it looks like we're preparing for a bout of higher inflation for longer, potentially again.
Yeah, I would guess so, Graham, wouldn't you? I think we know how this works as well. Inflation kicks off, cost of borrowing goes up because they're trying to get on top of inflation. Cost of living goes up, and therefore people start to struggle a bit more because there just isn't enough money to go to the end of the month. And if that happens and things are running out and they can't go to the supermarket and buy everything that they want to do, and they can't go out the weekend, they can't go on holiday, people understandably get a bit depressed and a bit fed up with that whole scenario because the cost of living just keeps going up and up and up, as we saw 22, 22, 23. And potentially that knocks on to the businesses, because if we're not spending, if we're not out and about spending money and having a good time, even on just the standard day-to-day living stuff that we all need, if we're not out spending it, that will affect profits. Interestingly, whilst for companies, I mean, interestingly, what has happened over the last 3 months, even before the Iranian situation kicked off, is that companies like BP and Shell, which a lot of our clients will have some holdings in, and a lot of big investment ISAs and pension funds will have holdings in companies like BP and Shell. Those two firms in particular over the last 3 months are up 17% each. They've done really well. So there are always opportunities when things happen, however awful they might be, and it's trying to find where those opportunities are and making sure that you don't lose your head. But markets go down as well as up. We all know that. That happens from time to time. It's part of the cycle. And blimey, we've seen a number of big dips over the last 20 years or so. I've been in this, as you have. We've both been in the profession, 30 years plus? And we're told that some of these black swan events are once in a lifetime. Well, I've been through 4 or 5. You've been through 4 or 5. We've all been through them. It's keeping your head and not doing the wrong thing at that point in time when those situations happen. We instinctively know we should buy low and sell high. Unfortunately, investors don't tend to do that. They tend to run away when things go down, which is the worst situation they can do, rather than trying to take some opportunities from them.
It's understandable, with clients worrying about the cost of living. They'll also be wondering what's happening with their investments with everything that's going on in the world. Now, fortunately, we've been taking a more defensive stance for some time with some of our client portfolios. Indeed, a lot of our client portfolios. So just explain what the catalyst was for your original decision to start repositioning our portfolios for this type of scenario.
Actually, it's a really good question, Graham. But actually, it started, when you think about it, way back with Silicon Valley Bank, First Republic Bank, Credit Suisse. There's a number of banks went bust in early 23. And for me, that felt a lot like the credit crunch issues when we had Northern Rock go bust back in October 07. And I went out to America in the early 08 for my kids were young, much younger then, and we went out for a trip to Disney and a week or two out there. And I could see from the people within even the holiday areas that we were staying at, they were really concerned about what was going on, and they were really miffed about, strangely enough, oil prices going up. And Americans in particular really don't like the price of gas going up. They really do not like that, because they've often in the past had pretty hefty cars to fill up, and so that's a real no-no. And I remember coming back in March 2008, April 2008, and writing out to all of our clients at that time, this is the time to take some profit, because the credit crunch was starting to kick off. And it felt a bit like that in 23. To be fair, let's be honest, I mean, we restructured our portfolios, increased the cash holding, but we also increased all the commodities holding, because the cost of living was just going up and up. And I expected that to continue as it was. And we had some exceptional returns, even with the lower risk. We've had some really exceptional returns for our clients over the last couple of years, and they're all very, very pleased, as I am, which is great. But these things change, and markets have looked overvalued now for a long time, and we've been waiting for that change to come. I think we are now getting closer. To be fair, I thought that we were there pretty much April last year with Trump tariffs. That was the catalyst. It wasn't. It dropped really, really quickly in a very short space of time. Global markets, 18% within a week for the US market. I think we were down about 14% in the UK market. And equally, over the next 2 or 3 months, it really kicked off again and did really well. And at that point, and for the last couple of years, I've felt for a long time that the UK looked better value as a market to be invested in than some of the US and European markets. And certainly last year, that proved true. We had for the UK and value stocks that we're in at the moment, that defensive approach. We might not go out the weekend, but we absolutely need food and water and heating and those consumer staples. And our portfolios are very much structured around that basis at the moment, that we're looking for value stock, the consumer staples, the stuff that everybody needs, regardless of whether they can go on holiday or not this year. They still need to eat, and they still need to heat their homes. They still need to buy food to put on the table for the kids, and all that kind of stuff. So we're positioned that way around. So strangely, the catalyst was actually some time ago. Then we had that Trump tariff scenario. Now this, I think, is much more concerning at the moment, but equally, there's much more opportunity potentially coming over the next few months with that as well.
So where do you see the opportunities really lying in terms of portfolio changes? What's your view on sort of asset holdings at the moment generally?
Well, as you know, I mean, most of our portfolios are really well structured from a defensive point of view already. And our best performing funds have been our commodity funds over the last couple of years or so. That's really pushed things forward. The exposure that we've got to gold and precious metals, that's done really, really well over the last couple of years, that many advisors don't move into. The fact that we have, and we've had it early, people are now starting to see that, oh, yeah, that really has done well. And we've enjoyed the run up through there because we were early with that for sure. And I suspect over this next 6 months to a year, certainly, whilst I'll be keeping a close eye, I suspect if the cost of living continues to increase, as looks likely at the minute, then those funds will continue to do really, really well. We haven't got enough silver in the world anyway for all the technology boom that we're looking at. There's a huge amount of silver being used in the military these days, in the front ends of missiles and such like that they're sending around all over the place right now. The the gold price has gone up considerably. Oil we're now seeing to spike up as it is, and that will not change until such a time they think that they can start getting either alternative energy sources. We should have had nuclear long time ago, and I think most countries around the world, especially the Germans who closed most of theirs down a while back, would agree that we really should be much more energy independent these days, and certainly for the UK, we could have and should have been much more energy dependent than we currently are. That needs to change, but until it does, inflation will drive up the cost of stuff. So having that exposure through to oil, gas, infrastructure metals, and precious metals is helpful, but not being overly, because they can be quite volatile, those funds, not being overly exposed to them, and keeping a good holding in consumer staple funds, and particularly the UK, where we don't have any currency issues to worry about. We've got no exchange rates with the euro or with the dollar or with anything else. We've got investments that we're investing in pounds, so we haven't got that exchange rate and currency risk to go with it. But if you're investing in the likes of the Tesco's, the Sainsbury's, the big brand names, the Glaxos, the Unilevers that are in the top 100 firms in the UK, things that none of us can do without: heating, lighting, eating, health, that kind of stuff. Well, that's probably a good place to be, and then certainly for the next 6 months to a year, and then review again.
Yeah. In terms of clients that might be feeling a little bit uneasy about their holdings at the moment, even when, as you say, they've got a lot of consumer staples in there, some commodities, and good balance generally in their portfolios with some cash. What do you think their view is at the moment, and how would you address any concerns that clients might have at this time?
First and foremost, don't panic. Absolutely do not panic. And if you're invested in money market portfolios, then the likelihood is that you've got some protection already in place for everything that's going on right now. So that's a good start. Markets do go down. That's always the way, and sometimes they go down more than others. But the majority of our clients will have some cash, because we've taken profit over the last few months, last couple of years. We've been taking profits and sliding that off where we can to keep cash healthy within their portfolios, so that it helps not to see much of a reduction when markets go down, because it's not fully invested anyway, and B, gives you some dry powder to go back into afterwards as well, which all of our newsletters and previous podcasts that I've done with Melvin Pride from the BBC, for the Money Minded Market Insights, we've been talking about that for the last couple of years or so. So we're structured fine. So for money minded clients, we're structured fine. And actually, this is potentially the start of what we thought was coming anyway, and we're ready for that, and we are in the right kind of places. For those people that are feeling a bit worried, that aren't in money minded portfolios and perhaps are 100% fully invested into other areas, and then maybe consider taking some profits off and thinking about how much risk do you want to take. This is not, and I repeat, this is not about timing markets. This is about portfolio defense and capital preservation at the moment. And the last thing that anybody should be doing is watching what's going on in the news, having a knee-jerk reaction and selling everything out. Rebalancing, repositioning, maybe. It depends on where those people are fully invested or not at the moment, and keeping an eye out for opportunities as they come along. But please, please, please don't panic. Even if it does go down, it will come back again over time anyway. So, and it's only a paper loss until such a time that you press the button and tell your advisor to sell. Then it becomes a consolidated loss, and you really don't want those. So don't panic, and keep an eye on what's going on and look for the opportunities.
That's been interesting to get your views, Ray. I think there's some really good information and guidance there for clients generally. If clients are feeling concerned, or if they've got any questions, they want to get in contact with Moneyminder, how would they do that?
Well, first and foremost, obviously there's a phone number, 01529 300 300. They can also email, but bear in mind that emails don't always get to the destination, and sometimes they end up in spam filters and junk boxes and such like. So if you don't get a reply from us within in 2 or 3 days, please do follow it up and chase up. Also, if people have found this podcast helpful and interesting, I would ask them, please do pass it on to friends and family, people that you think would find it helpful as well. And if possible, subscribe to the channel so that we can keep you updated as things change and move forward, so that you're always at the forefront of what's going on.
Excellent. Well, it's always good to hear your views. So thanks very much, Ray, and I'll speak to you soon.
Yeah, thanks, Graham. Take care. Speak to you later.